Our intent here is to educate as best as we possibly can, and as we're going through this, we're trying to make it as lifelike and as real as possible, and we're looking at these numbers saying, well, hold on, how about if you don't have 20% down?
Right, these numbers that we've been doing these scenarios with are predicated on 20% down because we're just subtracting principal, we're taking principal and interest and taxes and insurance and subtracting the taxes and the insurance. We should look at each other and say, well, gee, one thing we haven't factored in is private mortgage insurance.
So let's factor that in. Let's see how it affects things. Okay. And I'm going to move back to the camera and let the good-looking guy do his thing.
So, God, that's a scary thought. So let's talk about that. So PMI is private mortgage insurance. Private mortgage insurance is an extra type of insurance that you have to have when you get a house if you have less than 20% down. It's an excess risk insurance because a down payment of less than 20% is considered a more risky loan for a bank to give than a loan where a borrower has 20% equity. So that PMI is very expensive. So what we did is we took the example here. Our first example, a borrower had 2836 qualifying ratios and only $567 a month in debt. We found that they could qualify for $321,223 on a loan. Then we said, well, gee, what if they have more debt than that? What if they're millennials, they're first-time homebuyers, and their debt is not $567 but $800 a month? That's what the last video did. So a larger debt load reduces the amount that you can qualify for from 1983 to 1750, and so subtracting the same amount, 500 apples to apples for taxes and insurance, that brings you down to 1250 available for the mortgage payment, principal and interest, and 1250 buys you a mortgage of 277.50 at 3 3/4% for 30 years. Now let's look at how PMI impacts that. Let's take that same scenario. So we got a 1250 amount, and let's reduce that number further by $150 a month for PMI. That brings this number down to $1,100 available for just principal and interest. And so following our same calculation, $1,100 at 3 3/4% for 30 years gives us a loan of $238,264. So that further reduced the loan amount by $32,400. So you can see the effect of PMI on the amount that you're able to qualify for is substantial. That's why it's better if you can come up with a larger down payment. Now the reality of the situation is that frequently first-time homebuyers can't do that. They're doing all they can to scrape together the down payment and the closing costs for the transaction. So they may have to do a loan with PMI. But we need to know that in advance. My dad used to have an expression he always used called the 6 Ps. Proper preparation prevents pitifully poor performance. So what we need to do, we need to follow the 6 Ps here to get you properly prepared for the journey you're about to go on, which is the journey towards home ownership. And the only way we can do that is by doing reliable numbers. And this is the foundational aspect of buying a house. Tim's job is to make the home buying experience fun and informative, and he's going to show you houses and help you make the best decision on the house that best suits your family. He's going to protect you by making sure that the house is priced correctly. He's going to make sure that the house suits your needs and your family. He's going to make sure that the home inspection shows that the house is a sound investment for you. My job is to make sure that you're qualified to finance the house and that you won't be disappointed there, so that the two of us are trying to make the home buying experience a really good one for you. Because it's the most important purchase of your life, you need to make sure that you go about the prep work, which is pre-qualifying, correctly. If you do this work, the rest of the experience will be fun.
Bob, so you're making me blush, and therefore I'm not going to get in front of the camera again. But thank you.
You're welcome. So again, the key to buying a house and getting a mortgage is to get pre-qualified. Figure all this out before you start, and then you'll be able to buy the house that is the right fit for you financially. Because what nobody wants is for a buyer to be in a house that they can't afford. The market did that, and we had disastrous results for that. Now this is the way I've always done my job. This is the way this is the way I learned the business, you know, back in the 80s, and this is the best way to determine how much you can buy.
That's why we're partnered up.
That's right.
Thank you, Bob.
Thanks, Tim. Trust me.
It's the guy who works out 3 days a week with a triathlete.
Yeah, but I'm not a triathlete right now, so I'm a tennis bum.